multifamily cap rates are lower than I've ever seen them in my lifetime.
And anyone ever see anyone's lifetime?
Well, I mean, yeah. So in my lifetime, cap rates are the lowest, and debt is approaching the highest that it's been during my investing career. So if I'm buying a multifamily deal, I have to be putting in a higher exit cap than I bought it for. And if I'm not doing that, then I'm basically setting myself up for failure.
What is up, and welcome back to How to Invest in Commercial Real Estate. And we are back again talking about another exciting episode. But before we get into that, we're just doing a little update here. Things are slowing down. You know, debt is getting more expensive. Deals are interesting to underwrite now. And you're constantly going through these shifts in the market where debt is super cheap and you want to try to buy everything you can, or debt is expensive and it makes that picture harder, right? Your interest rates are changing. Your leverage rates are probably changing. There's a lot going on, and it's not like sellers, you're selling property right now. We just sold a property right now. We're not immediately just, the Fed raised interest rates, drop your price $1 million. Yeah. That doesn't happen.
Yeah, the 10-year was pushing 4% today.
Ooh.
So that's crazy. During COVID, it was less than 1. And so it's going up so fast, people aren't able to adjust.
Yeah, a year ago, we told each other, let's buy everything we can. Everything was great, and then now all of a sudden we're having to be more patient. So there's a big expectations gap between seller and buyer. So
it's not just on the existing side, even in the new construction side. New construction's an absolute bear. Oh, yeah. Costs are going up like crazy. Skilled labor is at a shortage. If you're on a floating interest rate, that sucks. Mm-hmm. I mean, it's just not the best time to be building something necessarily either. So there's definitely a lull that you can noticeably feel on our side going out and looking for deals.
Yep. But with this lull, opportunities will begin to present themselves because interest rates are going up. Sometimes people on floating rates. Yeah. People may have purchased property with a really low rate, and now they got a 5-year fixed or a 10-year fixed, and they're coming due for the refinance. And it may be that their rate is doubling, and it's going to put people in a bind, and it will create some opportunities.
Yeah, hopefully.
Yeah, so I love that, opportunities, because the biggest question I think anybody gets that's bought these types of commercial real estate properties, whether it's apartment complexes or industrial, really anything, if somebody who's interested and they're trying to learn, they come up to you eventually and say, hey, how are you finding these deals? Mm-hmm. Right? So that's what we're going to talk about today, is what criteria we're using to find the deals we're buying and to look at the number of deals we need to look at to buy the deals we want to look at. So I think that could be the first point, is you've got to underwrite a crap ton of deals. You've got to have a criteria like we came up with today, where you can go through and sit down in 10 minutes and underwrite a deal and see if that works. And then go on and spend more time. But 99% of the deals aren't going to fit in your criteria, and you can move on to the next one.
Yeah, and so you say, well, how are you finding the deals? People do ask me that, but that isn't the question they should be asking, because the deals are, there's thousands of deals. It's how are you underwriting the deals, or how are you determining what is a good deal? That's the question that people should be asking. Mm-hmm. And the thing is you have to get good at the underwriting part, so then you'll know when a good deal is a good deal. Otherwise, you're never going to find the deal that you want to buy because you don't know how to underwrite it. So today, let's talk about just the things we use to sift through the noise and to get to properties that we want to make an offer on.
Yeah, so the first one is, one of the more important, but it's the easiest one because it's the most advertised, right? When you see a deal listed for sale that has tenants and it's occupied, it's typically sold on a cap rate. That's the first one. You need to pay attention to a cap rate. You need to understand what a cap rate does and what that typical cap rate gets you in typical returns on the back end with a normal assumption, right? If you have a 15 or 20% required return and you're looking at a 5 cap Chick-fil-A, you're never going to meet that return, ever.
Well, okay, you could,
but
theoretically,
it would be very hard.
Not in the first few years, but you would have to bank on a massive increase in value in rents and a hot market in order to maybe get there in the future.
But generally speaking, a cap rate is taking the net operating income for that first year and the purchase price for that first year, and it's saying, hey, if you bought this property in cash, you would make this % return a year. So an 8 cap, if you bought an 8 cap deal in cash, you would make 8% that first year.
Yeah, so we'll remind each other, we're going to get flack because people always want to tell us that we're using the definition of a cap rate wrong. Yeah. I really don't care if they think that. But if you're buying $1 million building and it's being advertised as an 8 cap, what they're representing is that there's $80,000 of net operating income after 1 year, after all expenses, if you bought it all cash, you'd get $80,000, which is 8% on your $1 million that you invested in the deal. And so that's the first number we look at. It's the most important number. It tells me the most about the deal that I can get from one number.
Okay, but it's a complicated number to me because you just mentioned a 5% Chick-fil-A. We're trying to buy some 8.5%, 9% on multi-tenant retail. There's multifamily cap rates. Cap rates, I assume, vary based on location. So how do you know what a good cap rate is? You have to use all those in your evaluation.
That's right. It's one number in many numbers. And it could be that for whatever reason, the 5 cap could be a better deal than an 8 cap. We're not saying that it's not better. Yeah. It could be that the 8 cap is in a terrible location and it's going to do nothing but go down in value. And the 5 cap could be in the fastest growth market in the country. And so, yeah, you get a low year one return, but the rents are going to be going up and you're going to sell that later for a big gain. So you have to take, this is just one metric. We're going to go through about 10 or 12 of these.
Okay. Yeah. And what they're doing is they're taking the net operating income and they're trying to assign a market cap rate to that deal for that asset class. So they go look at similar deals, similar asset classes and similar locations and take their net operating income and the value they traded at. And that gives you a cap rate. And they take that market cap rate, they divide it by the NOI and that gets you a value. It's a metric of value, but what it tells you is that first year's net operating income, which is almost your starting return.
Yeah, and if you're looking at a 5 cap deal, so it's if you bought it all cash, going to return 5%, but you want to leverage that, okay, but you're going to go get debt at 6%. The deal's only paying you 5, but you're paying 6 to the bank to get the money to buy it. You're going to be negative cash flow. So the only reason you would do that is if there was some huge upside or you're going to go in and double the rents year 1 or 2. Only way that makes sense.
Or maybe some cash buyers might be okay with that.
Yeah, if you're an all cash buyer and you want to be as safe as possible and you want to get a Chick-fil-A, you know, in Dallas, maybe 5 cap suits you.
Sounds pretty safe.
Yeah, so we touched on negative leverage there, but one of my favorite topics and the next point on our list is positive leverage. And the idea of positive leverage is that we're going in and we're buying this 8 cap deal or this unleveraged 8% return deal, and we're leveraging that up because we're borrowing 80% of the cost to buy that 8% deal at 4% or 5%. So then we've got that 4 or 5% arbitrage or that portion of positive leverage, and that's where we make additional money. Right. So that's huge because a lot of things you can't buy using leverage. It's hard. It's riskier. But real estate is one of the easiest things to leverage up because it's easy to collateralize. It's easy for a bank or to go into a bank and say, hey, I'm buying this shopping center. I'm buying this apartment complexes. It's full of tenants. It makes this amount of money a year after all expenses. And after you take out debt service, it still covers the debt service by 1.3 times. This is a great loan for you. And that's what they're in the business of doing. So they'll give you that loan.
The bank's willing to do that, right? Because if something goes wrong, they don't want to generally, but they can always take over that property.
Right.
Yeah. And so people that are listening, think about this. If you had something that you knew could give you an 8% return or a 10% return for every dollar you put in it, and you knew that you could go and borrow money at 4% and buy that asset that will pay you the 8%, then you should want to ultimately and theoretically borrow as much money as you can.
Yeah.
Because once again, you're borrowing it at one number and you have an investment that's paying you more than it's costing you for those funds.
Yeah.
And so that's why the debt picture is so important. That's why leverage is so important to to real estate.
Yeah, and one of the first questions when we bring each other a deal, hey, here's this awesome deal, sweet, what's the debt look like? Because again, guys, that's 75, 85% of the purchase price. That's where the majority of the money is coming from to buy this deal. You need to understand that more than anything. That's a massive fulcrum point that you can move that adjusts your outcomes substantially on the front and the back end, whether you're paying origination or whether they're giving you a shorter or longer amortization period. It can affect you in a million different ways.
Yeah.
Okay, so cap rate, number one thing we look at. That's the first thing. Number two is what kind of debt we can put on it, because those two numbers help us go to the third point.
Cash on cash.
Cash on cash return. That is our third metric because we are cash flow buyers. We are not speculative buyers. We're not buying something and hoping that it goes up in value later. We want to make money for our investors day one that we buy it. Now, not every deal is like that. Maybe a new development deal isn't like that, but most of the stuff we buy, we want cash flow day one. So the cash on cash is a big number.
Okay, so when we look at it and we see a number, if it's, 5%, 7%, 10%, what do we think's good?
What do we underwrite to? So what I would think is good is if we can get our limited partners a double-digit cash-on-cash return and a clear path to it growing, getting to a higher IRR, which we'll get into later, I would do that deal.
So maybe somewhere starting at 10% or higher, and then growing throughout the hold period.
Correct.
Okay.
Now, there are bigger funds that have deep pocket investors, and they just want to get their capital allocated. And so they may say, hey, I'm happy with a 6% or an 8% cash-on-cash return. And that's fine, and we may be there someday. But a lot of our investors have appreciated the higher returns that we get. And, of course, we want to make more money on our money because we're not as rich as we want to be yet. So cash-on-cash, higher number is better. And so, double-digit returns.
I've looked at some of those really big deals where people are buying things for, I don't know, $500 million, and they get investors that are spending $10 million or $20 million, right? And those cash-on-cash rates seem to be less than what we target.
Right. So cash on cash, you're simply whatever money you had to actually get out of your pocket, whatever your wire was to the closing company, your total funds out of pocket, not including what you got in debt. That's a key indicator. You have to have that. I forget what I'm saying here. But the money you get in free cash flow every single year is divided by your initial kind of whoop out cash down payment. And that yields a percentage, and that's your cash on cash number.
Yeah. Okay.
All right. Let's go. Cap rate. Then we had the debt. Then we have cash on cash. What's the next one?
Internal rate of return. And the internal rate of return is really calculating the return on your money while it's invested in the deal. So once it's paid out to you, we're not calculating it, but it is really accounting a future sale, right? So that's the biggest assumption in IRR is you have to underwrite an exit at a reasonable price.
Yeah, you don't know your IRR till you sell it.
Correct. So that's an assumption in the beginning. And what you do is you have to assume some sort of income growth or no income growth over the period of time. And then again, for your exit, you're assigning a market cap rate or what you believe that market cap rate to be when you believe you would sell it. So a couple assumptions there. And then you put that market cap rate on your NOI for, let's say you're selling in year 5. You take the 6th year net operating income and you would divide it by your market cap rate, and that would give you your estimated value when you go to sell in year 5.
And the IRR includes the cash on cash that's been distributed throughout the deal, right?
Yes.
Yeah.
It does take that into account. It takes into account all of the equity pay down or the mortgage pay down.
Oh, right. Correct.
Because you're paying down that mortgage, so you owe less on it. And then you're also, like you said, you're assuming an exit cap rate and a purchase price or a sale price down the road. And so, you're paying down the mortgage. Then you sell at this price. Not only do you get the difference between that sale price and your purchase price, but you also get the difference between the purchase price and how much you've paid down your debt. And it takes all that number along with all the cash on cash that you paid out while you had it. It kind of bundles all that up, accounts for the time value of money, and gives you an average yearly compounding return. Yeah. We're not going to get into it any deeper than that on this show, but we have done one in the past, and we probably do want to get in the future.
Okay. So again, just to specify, the cap rate was the first one. We're buying on an 8% plus cap rate. Debt is the second one. We typically want to buy a deal that we can leverage up to 80% probably is a bare minimum.
Yeah. On at least a 25-year AM.
On at least a 20. That's a very good point. The next one is cash on cash. We need at least double-digit cash on cash and a clear path to that growing. IRR, what would you say our required IRR is? I'd probably say...
I like to look at above 20%.
Above 20%. I was going to say a little less, maybe 17.5, 18.
Brian's still way too optimistic for this market. But I think when I first started...
For this market, you're right.
Brian's made too much money.
When we first started, all of our deals were, to the investor, were
20 plus.
20%.
Yeah.
Now I would say if we had a deal that gave the investors north of 15, we would still be okay with that.
Yeah, I agree. Okay, so the next one that we're looking out for is price per foot. Price per foot is huge. Price per foot in relation to the cost to build that deal, again, is big. But at the end of the day, we own a shopping center and we bought it at $70 a square foot. And a guy was building one right across the street and it was like $400 a square foot. So what would you rather be in, a $70 per square foot basis or a $400 per square foot basis? And how does that translate to your rental rates? You're going to have to charge way more rent for your higher basis than you would for a lower basis in a building. You could get away with lower rents.
Yeah, so you limit your potential tenant base. As long, a lot of the times your $400 or $500, they're either in such a good location, like downtown San Francisco or something, LA or whatever, that you can just demand that. But if it's any other market, it would have to be a brand new development in order to command that kind of rent. Well, that's fine. But if the initial tenants go out of business, how are you backfilling that? And how are you going to get enough rent to cover a really high purchase price? Yeah. And on apartments, I would say we would use price per unit, kind of like we would a price per foot in multi-tenant retail. It's just a way to compare similar assets. So if I'm going to buy an old shopping center, I may want to get it at $70, $80 a foot. Maybe middle of the road shopping center, maybe $120, $150 a foot. Newer shopping center, $200, $250 a foot. And in apartments, it's kind of the same thing. C-class apartments or workforce housing, we want to be at 30, 40, 50,000 a door. Middle of the road apartments, maybe 1980s, 90s construction would be at 75, 80, 90,000 a door. New construction could be anywhere from, now 125 to 225 a door.
Wow. So when I see price per foots that are too high for my comfort, I see typically artificially inflated rent, right? You've got a Starbucks or some sort of national credit tenant. All of their tenant improvements or the cost to build out that space was built into that lease. So when you go to re-tenant it, you're not going to get that price per foot. No, right. You're not, because that wasn't the actual rental rate. That was so much bullshit baked into that number that gave him an artificially high rental rate, and therefore, the building is selling for a higher price per foot. Not always.
So what we're looking for, I would say, for me, it's on retail, unless there's a story behind it, less than $200 a foot. And I don't, once you get under $50 to $75 a foot, you're kind of getting into some really rough retail. There really isn't a number on multifamily.
Price per unit, I would say.
Price per unit, but I'm just saying it's a little bit different animal, and depending on the location and the vintage, you just want to be in line with the market on a price per unit basis.
Sound like a wine connoisseur there, the vintage.
Yeah.
All right. Anyway, the next one is super important, and there's a lot that bundles into that, but you need to pay attention and be aware of the demographics around the specific location that you're at. You want to know where those people work. Are there jobs to support them? You want to know, are people driving by my shopping center? Are there good traffic counts? How much money do these people make? How many people is there?
How do you find that number? How do you find the median salary of, within 3 square miles or something?
The broker will have that information.
Okay.
That's the easiest answer. But there are online services where you can pay so much per pool, per lookup, a location, or you can probably pay a monthly service, and then you can look up as many properties as you want. And it does a 1 mile, 3 mile, 5 mile radius.
Same for population, for the number of.
It's all included in a demographics report.
I see.
So what we're looking for, multifamily doesn't matter quite as much on this location.
Well, more jobs, right? Way more jobs with multifamily.
But retail, the location is extra important. But I tend to look at over 100,000 population market that it's in. If it's multifamily, if it's retail, I want 100,000 within a 3 or 5 mile radius,
right?
Not just the deal size. And I want the market to be probably 250,000 people or bigger for retail.
You think that's because people are willing to drive a little bit farther to where they live than where they live to where they want to shop? I mean, is that why maybe it's a little more important for retail than it is multifamily?
I think people that where they live is
you'll drive to work.
Yeah, you'll drive to work.
You'll drive to where you can afford.
Yeah, but as far as retail goes,
shopping, you just want to go.
Yeah, well, the issue is it's not where people necessarily are going. It's where a person wants to invest and open a business. Oh, that's a harder decision than just getting an apartment.
Yeah,
that's 2 miles down the road.
Yeah,
because he doesn't mind going that extra mile. But if a business doesn't think people are going to be driving by, they're not going to spend the money to open that business in that retail center. Yeah. And so that's going to cause that center to struggle. And that's why retail is more location dependent than multifamily is.
Okay. I would say, cars driving by a good retail center will have, 30,000 plus, 60,000 plus, could be more. But a good retail center, I mean, we've bought numerous retail centers with 50,000 cars a day on the hard corner or passing right in front of it.
I would say a minimum for me is 10,000 traffic count.
Right.
In front of the center. That would be a minimum. But the higher, the better. Population density. Once again, I think within a 3 to 5 mile radius, I'd love to have 100,000 people if I can. We don't always get it.
On the income, it needs to match your tenants, right? You don't want to look for, the median income is super high. But if all your tenants suck and cater to super poor people, then that doesn't do you any good. You need to match those two.
Or vice versa, right?
Or vice versa, right? You need to say who is going to shop at a Goodwill, who's going to eat at this taco place, who is going to get their nails done here. Is it a nice nail salon? Is it a crappy nail salon? And you need to make sure you're in the demographic for that area. People say, "Oh, I'd never buy there. That's a rough part of town." If you've got tenants that fit in a rough part of town and they're paying rent, I'd bet on that better than a lot of other deals. As long as it fits, it makes sense. Like, okay, this tenant looks like it should be on this corner. The people who come in and shop live. I mean, you can match make that.
That's why we don't have a Chanel store in downtown Jinx.
That's why we don't have a Chanel store in downtown Jinx. And that's why you have Saks Fifth Avenue and Utica Square.
Yeah, right.
Right. You see these things, and it starts to make sense when you're looking for them.
Yeah.
Because again, most people are shopping and dining and eating and going out to a bar and getting their nails done in a very close radius of where they live.
All right, what's next?
Next one. So this isn't as important to your returns, but it could really dampen them later if you don't take it into effect in the beginning, and that is deferred maintenance. You need to take in the vintage of the year, the vintage of the property that you're buying, the year, I tried to make a joke and I messed it all up, man.
But this is one I think I came up with. And once again, when you're thinking about, okay, I'm looking at all these deals, how do I quickly evaluate it? Those are the things that can trip you up. So if I'm looking at 2 8-cap deals, if one looks rough on the outside, needs a new roof, all the HVACs are original, and this one, has a new roof and the HVACs have been replaced, well then, one's a better deal than the other. So this is just one of these critical metrics that we use to quickly evaluate which deal we should make an offer on.
Okay, but on a quick evaluation like we're talking about, deferred maintenance is mostly just you driving by and looking at it yourself, right? Looking at the parking lot, because you can't look at the roof.
Not always. Some of that stuff is listed in the OM. Sometimes you can call the broker and prod.
These are things that you can ask in one phone call with the broker.
Okay.
Hey, what is the age of the roof? What condition is it in? What kind of parking lot does it have? Is it asphalt? Is it concrete? What condition is it in? And then certain amount of it you can just tell by the pictures.
Yeah.
Is, hey, what am I going to? Is there any CapEx or deferred maintenance dollars that I'm going to have to allocate to this? And is there anything serious that makes that 8-cap look more like a 7.5? That's what we're getting at there.
Yeah, and as you go through it, you will gain more experience. It's like the bathroom remodel guy coming in and spending 5 seconds in your bathroom. It's like, oh yeah, it's going to cost $25,000. Yeah. It's like, but you didn't do anything. You didn't crunch it. And it's like, listen, lady, I've done this 1,000,000 times. What you said is going to cost $20,000 or a little bit more or a little bit less, but right around there. Now we're looking at properties. We're taking the square footage. You can multiply a price per foot of TPO in your head. You can guesstimate what asphalt would be. You can estimate what leasing commissions and tenant improvements might be because you're going to be the one paying those and doing those. You should have a roundabout number. Now we can look at a deal, and if it's 50, 60,000 feet, you can almost just plug in $300,000 as a placeholder number and then modify that as you go. It's like, this will get me some vacancies leased. That'll get me a new parking lot and a good chunk of the roof, and go from there. Back it down, raise it as you have inspections.
Yeah. All right.
Next one, tenant risk. This could be an interesting one because the bank is looking into this a lot. You should be looking into this a lot. You have a lease, right? And you may have 50 years of lease term, but how sure is that lease? How do you know that tenant's going to pay you? Is there any risk of them going out of business? Is there any risk of them relocating? There's always tenant risk, but it's just how much of it. And it goes in, like we were talking about last week with the implied value. This is one of those calculations you're taking in. What is the probability of the tenant losing? Say you have one tenant. What's the probability of them leaving? And then what's the probability of them staying? And you need to be prepared for both of those circumstances.
How do you tell if a tenant's going to leave or not? Maybe based on how long they've been there?
Well, you can go, if it's a restaurant, for example, and you go in there on a Friday evening for dinner and it's dead, I would not assign them a high probability of staying open. If you go in there and it's packed, you can assign them a better probability. Yeah. If it's a publicly traded company, you can assign a better probability of them honoring their lease term. Mm-hmm. If it's a more regional company, again, if they've got 5-7 locations, like our El Luchador deal, I was mind blown that we were able to get the exit cap we got on that deal because it was a 1-unit operator. It was 1 unit. You didn't get a guarantee from this 50 restaurant conglomerate.
Yeah.
But think about an Olive Garden. Think about what Olive Garden would have to do to get out of that lease with you. They would have to declare corporate bankruptcy.
Yeah.
They can't just...
There's a corporate guarantee, yes.
Yeah, so that's huge. That's why they sell at a lower cap rate and people are willing to make less money on them, is because of the surety of Olive Garden staying and honoring that lease, at least while they have lease term.
People still eat at Olive Garden?
No.
Well, so what does it mean to me? I'll take a slightly different bend on the tenant risk. Is you don't know which tenants are going to leave necessarily. But if you take a quick look at the rent roll, and 80% of the tenants have expiring leases in the next year, that's a higher risk because they can easily leave at the end of their lease than if you take a look at the rent roll and there's at least 5 years left on every single tenant. That's a lower tenant risk than the previous example. Okay. And so some of them might be, sometimes I get these deals where they're marketing it and I look at the rent roll and the lease expired already.
Oh. Yeah.
And I'm thinking, okay, well, are they still there? Why haven't they renewed? They're on a month to month. And so that's what we mean by tenant risk, is take a quick glance at the rent roll. How much lease roll do you have in the first year or two? What kind of leases are they on? Triple nets, month to month? Do they have a long, 5 years left, 8 years left? That's some of the tenant risk, in addition to looking at your tenant base and seeing, okay, some businesses do better than others. Like a postal office, they have addresses and people paying on monthly subscriptions. That's a better, more secure business model than another type of business, like a jewelry store or something by a local person. That's their only business, and they just sell trinkets. Okay, they can go away pretty easy if they don't have the sales. Yeah. So that's what we mean by tenant risk. Okay.
Yeah, and there was a good example, that apartment complex in North Carolina. It was in Jacksonville, right? So you had more tenant risk in that apartment complex because there was so many Marines stationed for camp there that when they would ship them off and they bring you military orders, they can just move out. I mean, as they should be able to. But you had a higher tenant risk there because people can leave with military orders, and it's a military town.
Yeah, or they maybe just shrink the size of the base all of a sudden.
Right.
So, okay.
Next one is deal size. This is one of the easier ones of the two. And again, going back into talking and having discussions with brokers, when you're calling on a deal, the deal's already sold or gotten a contract, or what he says didn't appeal to you, or even you submit an offer and get in contract, but it falls out. You need to be telling the broker, hey, I buy deals in between X and X. You should give him 5, 7, 10 parameters, him or her, whoever the broker is, to say, this is the type of deals I buy. They're obviously in the business of selling deals. So what? You missed out on the first one. It's a numbers game. You just need to look at more deals. Get that person to send you more deals. Give him your criteria. They're going to put that in their little CRM or database or whatever. Hey, this is a buyer at $5 to $10 million deals at this cap rate in this part of town and in these markets or whatever. That's just another. You have no business looking at $20 million deals if you know you don't have $4 or $5 million.
So the main thing you're looking at is too small of a deal. Maybe it's not worth your time. Too big of a deal. You can't raise the equity. Is it pretty much?
Yeah. Even if you could raise the equity, is it taking on too much risk? Because like we talked about last week, every deal has a potential of not working out, even though it may work out 80% of the time. So can you stomach that deal if it fails? Do you have the cash reserves? You raised the $4 million, but what if it starts losing money and you need another couple million to keep it afloat through a hard time? If you can't do that, if that deal's too big for you, then you shouldn't be spending time.
So you don't want it to be a disproportionate amount of the total amount of deals that you have.
Yes.
In case something goes wrong.
And the lender is probably going to shut you down before that. Anyway, your investors will probably shut you down before that. What do you mean you want to buy a $50 million deal? How many $50 million deals have you bought? You bought a $40 million deal? Nope. Bought a 30? Nope. Okay, so we're going from 7 to now this one's 50 and you know what you're doing. The bank's probably going to tell you, hell no. Yeah, the investors are probably going to say a similar thing. Hey, use somebody else's money for this first $50 million deal. Yeah. You have to gradually get there. But again, it's just a parameter of, what you're putting in the search list of CoStar or Crexi or wherever you're getting your deals. There's no point in looking at $30 million deals if you can't buy them and you can buy a $5 million deal. Just put the max at like $6 million, leave yourself some negotiation room or whatever. All right. Next one.
Yeah, we need to go through these pretty quick.
Income growth assumptions.
Income growth assumptions.
Yeah, this is a big one for us because you can have the cap rate, which is kind of a year one cash flow. It kind of helps you get a year one cash on cash. But we have to kind of try to forecast, what is this deal going to do in the future? Is it on the way up? Is it in a great area? Am I going to increase rents over time? or am I not going to be able to? And so that's one of our quick evaluations that we go through.
Yeah, and sometimes they're built-in rental increases to the lease. So just reading the lease and seeing this tenant has 10% annual increases. You bought a deal that way, right? The face value cap was low. It wouldn't have met that parameter. But when you look at the income growth assumptions, it's like, hey, man, we get to a spot in 18 months where I would buy this deal. Can I suck it up for 18 months to get a good return in 18 months and then get a better return in 36 or 72 months or whatever it is?
And along with that, you're evaluating where the rents are in line with market. And so that will tell you if you have room to run on your income growth. If you're buying really high rents compared to everybody around you, then you're probably not going to be able to get as high of rent growth as you want. But like an example of, we have a deal in Tulsa where it was an older center. Rents were $10 to $12, $13 a foot. And a mile down the road, they're $25 a foot because it's a little bit newer area. Well, that's great for me because I know I'm below market. Yeah. And if someone wants to rent in that area, they're going to have to, rent from us or from them, but I'm half of their rent. Yeah. And so now I can start pushing those rents. So there's some big time upside there. So I should be willing to pay a little bit more for that property, take a little bit lower cap rate because I know I can grow that rent.
And again, these are cohesive, right? You have a lower basis, you have a lower price per foot, so you're able to charge cheaper rent, and comparable rent is way more expensive again because their basis is so much more expensive. So you can see how some of these are already starting to fit together. Yeah. Just like this one and the next one, right? So annual rent growth or the assumption of what rent growth you're going to get. The next one's the exit cap rate. So to get an IRR, you have to figure some sort of rent growth. You're not just going to assume it's stagnant for 5 years, and you have to get an exit cap. So these are important and they go with each other. An exit cap rate, you can't assume if you buy an 8 cap deal that it's going to be an 8 cap deal in 5 years or 10 years or 15 years. You have to put some thought into that. It could change, right? How could it change?
Well, we purchased a property that we purchased at like 9.5 or 10 cap, but it was because of some risk that it had with a couple of tenants. But I knew if I could alleviate that risk, that it's probably an 8 cap deal. And so that helped me. I built into the model. I built enough cash to handle a worst case scenario in changing that problem tenant out. And then I put a lower exit cap, which isn't always normal, in order to get an IRR.
Can you get a lower cap rate? Could it change because you're making a lot of improvements to the property?
It could change because you're making a lot of improvements. It could change because the area of town is gradually getting growing better. Yeah. It could change because debt is cheaper than dirt. Yeah. It could change because debt is insanely expensive. Right. All of these factors are going into it.
Like right now, if you're buying multifamily cap rates are lower than I've ever seen them in my lifetime.
And anyone ever see anyone's lifetime?
Well, I mean, yeah. So in my lifetime, cap rates are the lowest. And debt is approaching the highest that it's been during my investing career. Yeah. So if I'm buying a multifamily deal, I have to be putting in a higher exit cap than I bought it for. And if I'm not doing that, then I'm basically setting myself up for failure. Yeah. Or I'm just lying to the investors in order to get them an IRR that they're comfortable with to invest with me. Yeah. So people are buying multifamily deals at 4.5 cap right now. Wow. And debt's pushing 6. And so they should be, if they're looking at a 5-year window, they should be, putting a higher cap rate on that. Mm-hmm. Maybe it's 5, maybe it's 6. I don't know how much they want to go, but right now. It's just part of what we have to go through when we underwrite deals to quickly evaluate them.
So the next one, I'm going to tie in with this one on a story about a sale we just had, but the next one is potential upside, right? We always want to look for a deal that's got a little bit of maybe an out parcel, maybe some vacancy we can lease up, but hey, it's good now, but here's this little cherry on top. If we could do that, it would be amazing. So talking about exit cap rate, we bought a shopping center in Wichita, Kansas, and it was a mid $7 million deal size, and it was 111,000 square feet of multi-tenant retail, roundabout. We did nothing to the out parcels, and we bought them at an 8.5 cap, and we sold them on a 5.85 cap. Yeah. We did absolutely nothing. We figured we would do that because, again, the people who are buying single tenant retail deals typically buy on much lower cap rates than people who are buying multi-tenant retail buildings. So we are comfortable with the multi-tenant side. So that was both something you could sell at a significantly lower exit cap than you were buying on, and it was a nice little potential upside for the deal. So it fit both of those parameters.
Yeah, that was great.
Stephanie Promenade is similar, right? You got to Vegas, and it's like this is an amazing shopping center, even if we don't have this extra ground lease or pad site to sell. But man, if you do that, that's an extra $1 million. That could be amazing. So again, just going back into our discussion last week about implied value, you have to assign probabilities on some of this and say, okay, the downside, I could lose my biggest tenant and that I may stall distributions or lose a few $100,000 in trying to re-tenant that space. But the upside is the property is going to continue to appreciate just like it has. And I could sell this $1 million, acre that nobody assigned any value to before I bought it.
Right. All right.
Yeah.
That's it. That's the 11.
Okay.
So anyway, just to follow up, cap rate, debt, cash on cash, IRR, price per foot. I'm running out of fingers. Demographics, the property condition, the tenant risk, the deal size, the income growth assumptions, the exit cap, and the potential upside. This is a list that we came together this afternoon and created in 10 minutes because we're using it all the time. We're looking at deals all the time. We have parameters of what we know we would buy. So when you see it, you can act on it. These deals fly fast. Time is fleeting.
Well,
time
the number
kills
one thing
deals.
people ask me is, Joel, how do you evaluate deals? How do you know what to buy? That's one of the things I get asked the most. And it's hard for me to tell them in a sentence, but this list at least gives them an idea of how we're going about evaluating deals and kind of using all of our experience on each one of those points to come up with which ones we want to make offers on.
Yep.
Anyway, that's the name of the game. You got to be underwriting deals. You have to have a criteria, and hopefully this helped you identify what your criteria could be. Anyway, thanks for joining us, and join us next week on how to invest in commercial real estate.
That was long.